Perhaps contrary to popular belief, becoming a successful investor is more about your ability to control your emotions than it is about having a particularly high IQ. Don't take my word for it. Take the word of legendary investor Warren Buffett. Here he is in his very first television interview back when he was worth a measly $500 million as opposed to today when he's worth $87 billion.
Warren, what do you consider the most important quality for an investment manager?
It's the temperamental quality, not an intellectual quality. You don't need tons of IQ in this business. I mean, you have to have enough IQ to get from here to downtown Omaha, but you do not have to be able to play three-dimensional chess or be in the top leagues in terms of bridge playing or something of the sort. You need a stable personality.
Assalamu alaikum, my name is Rakan Kayali and welcome to Practical Islamic Finance, where we try to understand financial matters and build wealth in a way that is in line with Islamic principles. If you need halal funding and you live in the United States, go to fundmebff.com. If you're looking for a halal investment and you earn more than $200,000 annually, go to fundmebff.com and apply to become an investor. In this video, I'm going to go over the emotions that have the greatest influence on the quality of our investment decisions. It's important for us as investors to be aware of these emotions and their effects on our behavior so that we can control them and moderate their effects and hopefully come out with better investment decisions. The first emotion that I want to mention is the fear of loss. Psychologically, losses have been found to be more painful than gains are pleasurable. The pain of loss causes investors to hold on to losers even when there is very little prospects of that investment going up again in order to avoid recognizing their loss. As an example, if an investor buys shares in company XYZ and he buys those shares at $50 a share and they depreciate in price to $25 per share, even if there are very little prospects of XYZ shares going back to $50 a share, some investors will hold on to their shares because selling their shares means recognizing their loss, which is very painful. On the other hand, fear of loss causes some investors to lock in profits too quickly and therefore limits their upside. So going back to the example of XYZ company, if someone bought shares at $50 a share and their fundamental value of those shares suggests that their price should be $100 per share, if the price of those shares goes up to $75, some investors are tempted to sell their shares in order to lock in the profits that they have in order to avoid any pain that they may experience if the shares go back to 50 and they don't continue appreciating to 100. So in a nutshell, the fear of loss causes investors to sell winners and hold on to losers in order to avoid recognizing loss and the pain that comes with it, and in order to avoid potentially losing profits and the pain that comes with that. Even worse, some investors, when they experience a loss, will look to recover that loss quickly in order to get themselves out of the pain that they're experiencing from that loss. And in order to get themselves out of the hole, they may invest in something that's very risky in order to make up for their loss very quickly. To counteract the negative effects the fear of loss have on your investment decision making, make sure you have a long-term perspective on your investments. Number two, make sure that you're not evaluating your investment positions too frequently. And number three, make sure you're making buy and sell decisions based on the fundamentals of the investments in your portfolio and not based on the profit and loss score sheet. Don't fall into the trap of selling your winners and holding on to your losers. The second emotion that's important for you to control when you're investing is overconfidence. People have a tendency to overestimate the power of their reasoning abilities and of their intuition. As an example, if you made a 15% return in 2019, you might think that you're a good investor. But what if I told you that the S&P 500 was up 30% in 2019. There's an old adage on Wall Street that says, don't confuse brains with a bull market. If you made a 15% return on your investments in 2019, you got beat by someone who just bought the S&P 500 at the beginning of the year and then didn't make any other investment decisions throughout the year. Now, the reason I'm mentioning this is not to disparage your investment abilities. Rather, the reason I'm mentioning this is because overconfidence has been associated with too much trading. Because people who are overconfident think that their trading is creating more value than it actually is, and therefore they tend to overtrade. And study after study have shown that trading too much lowers your returns. Between 1991 and 1997, the 20% of households that traded the most underperformed the market by 6.5%. And then the less trading a household did, the better their returns were. To counteract overtrading, make sure you're reviewing your winners as well as your losers. And make sure that you're reviewing past investment decisions to identify the things that you did right and warrant reinforcement and the mistakes that you may have made. The third emotion, or I'm not really sure if this is an emotion, but attribute that you need to be aware of and mindful of is self-control. Lack of self-control comes from an inability to delay pleasure. People need their dopamine rush now, and sometimes they are willing to sacrifice substantial future benefits in order to have their dopamine fix right now. Lack of self-control will impede your ability to achieve any of your long-term goals. Allah subhanahu wa ta'ala says in the generous Quran, أَفَرَأَيْتَ مَنِ اتَّخَذَ إِلَهَهُ هَوَى, which means, have you seen the matter of whosoever makes their desires their gods? Lack of self-control can cause people to take on excessive amounts of risk in hopes of gaining a big return in a short period of time. It can cause them to take out their retirement savings early in order to support immediate consumption. And it can cause people to not save enough to achieve their financial goals. And as a result, when they get older, sometimes they'll take on excessive risk in order to make up the difference between where they are and where they need to be. Things you can do to gain more self-control is to write down your long-term financial goals and make a plan on how to achieve those goals, and then reward yourself periodically as you progress towards these goals. Number 2, remove temptation. So if you have the Robinhood app on your phone and every time you open your phone it's winking at you and telling you to make a trade or to check on your investments, then maybe you shouldn't have that app on your phone. And by the way, I'm not against using the Robinhood service on your desktop, for instance. I'm just against having it on your phone or having any other stock trading app on your phone where you're tempted to always check on your investments and perhaps make rash investment decisions. And then third, I would say, as it relates to self-control, is don't give up on yourself. If you do something out of lack of self-control, then acknowledge it and try not to repeat it in the future. Nobody's perfect and you never will be perfect. The trick is to keep trying, learn from your mistakes, and not give up on yourself. That's how you improve over time. And that's really the goal. The goal is improvement, not perfection. The fourth emotion that it's very important for investors to control is the emotion of regret. Regret is the feeling that an opportunity was missed needlessly, and it is typically associated with hindsight bias. And hindsight bias, as we mentioned in the previous video, is basically when past events appear to be a lot more predictable than they actually were at the time. Regret is particularly acute in volatile markets where investors think they could have predicted the market movements and they could have increased their gains or reduced their losses. This feeling of regret can cause investors to do some silly things like buying shares in companies that they wish they owned last year. Regret is different from disappointment because regret is often associated with feelings of personal responsibility. This causes some investors to prefer to invest like everyone else is investing because after all, they can't be blamed personally if everyone else was doing the same thing. To counteract regret and the fear of regret, make sure you're diversifying your investments. That way, if one or a few of your investments don't pan out like you would have hoped, the loss isn't great and the regret is minimal. Understanding the emotions behind the investment decisions we make is the first step towards controlling these emotions. I hope this video was beneficial to you. If it was, leave a like for the YouTube algorithm, subscribe for more content. Until next time, take care of yourself and happy investing. Assalamu alaikum and peace be upon you all.